Hi, Beth Riebenstorff with the Reby Homes team, your trusted source for real estate in the Phoenix metro area. So it's April 2021, and let's start off with a year over year market snapshot of some of the key changes. Showings are up 49.5% year over year, meaning a lot of people are getting out and looking at homes. Purchase applications, well, they're up 39%, and pending deals, which actually measures February activity, it's down just slightly, and both existing homes and new home sales are up almost 10%. With the increase in sales and purchase contracts, the issue remains inventory. We're seeing a rise in interest rates. The average 30-year fixed, as recorded by Freddie Mac, is at 3.18. To put that into perspective, we saw toward the end of the year dipping down into the middle twos, somewhere around June of last year. And 16 times last year, we saw a new low in the average 30-year fixed. Now, it's begun to come back up as the economy improves across the country. The reality is, as George Ratui sums it up, home sellers and home buyers have gotten really used to extremely low rates. Rates even in the 3s to 3.4% range will remain extremely affordable by historic standards. Goldman Sachs is predicting as high as 3.75 by the end of the year, and others are saying more on the lower end, 3.25. The high demand and the low interest rates have caused the inventory challenge nationwide. This snapshot of new listings coming onto the market as compared to total listings in the country shows we're down about 52% year over year in the number of homes that are available, causing this deficit. State by state, the majority of the country is in the red zone, down at least 60% or more year over year for inventory. Arizona, Utah, and Idaho lead that, with Arizona at 63.9, Idaho 66.4, and Utah down 68.1% year over year. As it stands right now, the inventory situation across the country is dramatic in the lack of available homes for sale. So what are some of the causes and effects for the lack of inventory? Single-family housing units that have been completed for the last 13 years, they've been below the 50-year average. In 2004, 5, and 6, some of the record-setting times in our business, 4 consecutive years of record-setting numbers of units were being built. There were 3 years in '04, 5, and 6 where more than 1.5 million homes were built. It had never happened prior to that, and it has not happened since. Following that time, builders have not been bringing to market the number of units to keep up with population growth. Building permits are up right now. However, there's a new and significant concern about the cost of materials for the new home market. And what about the cash out refinances? Lots of headlines there. Cash out refis surged to their highest level since financial crisis, leading to the question, are we seeing a cash out refinance crisis? So what's true and what's not true about that? Here's a look at home equity cashed out by refinances in billions. What's true is 153 billion last year in cash out refinances, the highest since the crash. What's also true is back at the height of the market just before the crash, it was double that at 321 billion cashed out. The amount of tappable equity that US mortgage holders have has surged since then. Tappable equity is the amount available for a homeowner to access before hitting a maximum 80% combined loan to value. For a $100,000 home, if you owe $80,000 on it, that's an 80% loan to value. Equity over the last 10 years has increased, and fewer homeowners have cashed out that equity. Back then, tappable equity was close to $5 trillion, while today that stands at over $7 trillion. Cash out refinances in 2020 were nothing like 2006. Back then, 89% of refinances were cash out refinances as rates were trending up in the first half of the year. For the last year, we've been in a downward trending interest rate environment, and only 33% of the refinances were cash out refinances. The total cashed out back then was 325 billion, which is 7% of the tappable equity. Compare that to today, 2020 numbers at 153 billion, which is 2% of tappable equity. With home prices rising, what are people doing with their equity? Are they accessing it? Are they misusing equity like back in the housing crisis time? Well, the Wall Street Journal wondered the very same thing. In a recent article, they said, The residential real estate market is on its biggest tear since 2006, just before the housing bubble burst and set off a global recession. Yet, in nearly every meaningful way, today's market is the inverse of the previous boom. In the mid 2000s, loose mortgage lending standards enabled borrowers with poor credit histories to purchase homes beyond their means, sometimes with mortgages that require low down payments in the early years of the loan. We know that today lending standards have changed and it's very, very different. What is similar is the tremendous demand. NAR saying with demand for homes outpacing new listings, buyer competition continues to intensify. On average, there were 4 offers per home sold of a closed home in February. A year ago, there were 2 or 3 buyers for every home sold. The intense competition has led to double-digit price growth and properties selling in record time. To get back to a healthy supply, an equivalent of 6 months of monthly demand, an additional 2.7 million homes needs to be on the market for sale, meaning the deficit of 2.7 million homes is driving the home price increase. The increase in February of 4.1 offers per home sold is dramatically higher than it's been for the last several years, spurring the intense bidding wars and driving the price increases. That leads to the question, is this like last time? Is this like 2006, the precursor to 2008? Here's a comparison of the two markets in the time leading up to 2006 and the time to today. First is an annual home price appreciation. No question, we've seen significant home price appreciation. CoreLogic puts 2020 appreciation at 9.2% overall. The years surrounding the lead up to 2006, so 2002 to 2005, the average annual appreciation was over 10%. Compared to 2017 to 2019, the average is 6.3%. Well, what might that mean for those that are buying homes now? Here's a look at default risk. So basically, lending standards today is compared to back then. The yellow line represents the reasonable lending standard, a little bit of product risk and a lot of borrow risk in 2005 and 2006. Today, product risk has been eliminated. The loan products that were in the market then, well, they're not around today. Borrower risk has been severely cut back. It's much more difficult to qualify for a home loan today. Another interesting comparison is single family inventory, which was rising in '04, '05, '06, and '07. And prices were going up, whereas today, inventory has been going down and prices are going up. As Deputy Chief Economist at First American puts it, it's not just a seller's market, it's a super seller's market. This is an incredibly competitive home buying environment. The average gain in a mortgaged home over the last year has been $26,300. The average equity overall is $204,000, and 38.2% of homes are owned free and clear. 16.2% is the average increase overall in equity, totaling over 1.5 trillion. With equity surging, folks are considering their options. Do we want to leverage that equity and move up or do something else with our housing? A look at equity gains by state shows California at 55,000, Arizona at 36,000, Utah at 39,000, Washington 47,000, Montana 40,000, and Idaho an average of 48,000. So what do all of those things mean, especially if you're a buyer in today's market? Well, a great analogy comes from Mark Fleming at First American. Imagine trying to fill up a bathtub with water, but the drain is open and the faucet is on. Think of the faucet as the flow of listings and the drain are the closings. At any point in time, the amount of water left in the tub is the available inventory. If the drain is less open, meaning there are fewer sales, the more water remains in the tub. And if the flow in the tub is slower, meaning there are fewer sellers listing their homes, and the drain is still wide open, well, the level goes down and there's less inventory. And what's happening today is the average days on market is 21 days, meaning the flow of homes is steady, but it doesn't show up as available inventory because closed sales close before it can be measured. Another analogy is the toilet paper and sanitizer shortage. Were the empty shelves due to a decrease in the amount of product manufactured and delivered? Was there really a shortage? It felt like a shortage, yet the sales volume was through the roof. It feels like an undersupply issue when it's really an over demand issue. And wrapping things up for this month's update is a look at the Phoenix metro area specific appreciation numbers from the year 2018 to 2019 to 2020. For under $300,000, the price per square foot started in 2018 at about $130 a square foot, moved up to $139.15, and in 2020 all the way up to $174.52. For 300 to 600,000, it went from 167 to 176 to 202. For the 600 to $800,000 price band, starting in 2018 at 225 to 24, not much of a move in 2019 at 225.76, and then it jumped to 249.81. And the over 1 million 2018 started at 367.55, didn't move much at all in 2019, 367.66, and in 2020 has jumped to 411.89. Thanks for joining us, and thanks for choosing Reby Homes as your trusted source for real estate in the Phoenix metro area.